At the very least, there's a lot of uncertainty in the market right now. Probably a lot of you watching this video have different strategies you're thinking of employing. Some of you think it's a nothing burger you're buying right now. Some of you are piling up cash, whatever it may be. Assuming there is an actual bear market, what is good moves in it? That's what we're going to be discussing in today's video. Now, I'm not talking full on crash or recession. I'm talking more just an underperforming market, kind of what we saw beginning in early 2022 and ending kind of in early 2023, where we saw a market, it wasn't good. I mean, we saw it fall significantly, but it's not like a complete recession was happening. People were worried the economy wasn't doing good, inflation was bad, rates were high, you could get a lot of money in CDs, people parked money there. So what does it look like in a bear market? How should you play it? Now, there are some distinctions I want to make early in this video so we're all clear, because it can get kind of complicated. But what you should do in a situation versus what you should do if you knew exactly how it was going to play out is very different. For example, if you knew the exact top, if you knew, even not exactly, but if you had a very good idea of where the top was, good idea where the bottom was, you would obviously play it very differently than if you didn't know what was going to happen. We live in a world where we do not know what is going to happen. That's just the reality. So it's easy to say, okay, we should sell here, buy when it's lower. But it's difficult to do that sometimes. Now, I'm not saying you shouldn't sell anything. I'm not saying that. But what I am saying is selling and timing the bottom is a lot more difficult than we would like to admit. Then it sounds, oh yeah, you sell here and you buy lower. But what happens if you think it's going to keep going down? If it falls 20%, 15%, 30%, 40%, you can honestly, or it's very easy to convince yourself it's going to continue to fall. So I personally am a big fan of holding stocks I truly believe in, and I don't generally invest in stocks that are risky enough that I'm worried about them going under if there was just a couple years of the market being poor. So if you're investing in more risky stocks, unprofitable stocks, ones with high debt that might turn over, it would make sense why you'd want to dump them and maybe buy in much lower, whatever it may be. But companies that are solid, that have good balance sheets, don't rely on lots of debt, huge moats, large market caps, I'm not particularly worried about holding those for a year or two or three, even if they're flat and they don't have a substantial dividend. That's how I like to invest. You guys can, of course, deploy capital how you want. So I'm going to move forward with that sort of thinking. It's very important to find a balance and understand your risk tolerance going into it. Because, for example, you might want to say, hey, there's these XYZ stocks, they're a little bit more risky, but I think they're great companies, they're going to get crushed, or they're going to continue to go down. I'm going to buy in low, and then it's going to bounce right back up. When everything recovers, I'm going to do amazing. It's technically not a bad strategy, but what if you were to buy in after it's already, let's say, 30, 35% down, and it drops another 15, 20%? And that sounds extreme, but guys, Meta, let's pull it up real quick. And I know they were having particularly poor earnings. It truly is one of, other than like an NVIDIA, it is a crazy story. That is not the right chart. From highs in 2021, even late 2022. Let's just take late 2022. That's what we're looking at with the NASDAQ. You're at 330. You fell all the way to 111, right? You're a third of the price, and that's a large company. That hasn't one of these. So what happens if you buy a company, you buy Meta at 219, and then it falls to 111, something like that. But let's even a riskier example. It's tough. It's very, very difficult. And obviously in this particular story at the end, just a crazy graph upward. Meta's done phenomenal. But the point is, you have to understand your risk tolerance. So what I look to do in a bear market, not a major recession, but just a bear market running sideways, running down. No one's super optimistic. Companies are maybe even having poor earnings. That was happening, obviously, during this time frame. What I want to do is I want to buy into solid, safe companies, large companies that have, like I said, good moats, all things like that are down fairly substantially, whether it be 10, 20, 30. We can see it. And you know me, guys. I love TSM. TSM was hitting lows in 2022. If you bought in at 87, you'd be doing phenomenal. We can do so many different companies. Even something like, let's take a look at Apple, not app loving. I always do APPL instead of AAPL. Throws me off. Apple was flat, right? Let's do late 2022. We were at 168. You could have bought in at 130, something like that. 131. You could have bought in here at 130, 120. You would have done very well on it, even though it didn't fall a crazy amount. And that's fine. It doesn't have to fall an insane amount for you to do well on it. And then ETFs as well. I generally cover single stocks on this channel, but you can always do well in ETFs. I hold plenty of ETFs in retirement. I like to invest in single stocks because I have a passion for it. But for many people, just investing in something like VOO, long-term retirement, that is perfectly fine. I would actually recommend at least a stable amount of stocks, a stable amount of your retirement investment in ETFs, if not all of it, personally. But you guys can do whatever you want. So ETFs, not always the most exciting. They're going to do well. Solid companies that are down fairly substantially, that aren't just getting absolutely wrecked. Like, I want to make the distinction between a company that's just getting absolutely slaughtered because of the specific, like, for example, if you really like automotive industry, and I know a lot of the tariffs have already been waived for automotive industry, but let's just use that example, right? If automotive was getting crushed, something like a Tesla, right? Let's take a Tesla. If Tesla was getting absolutely crushed, I don't think they do much importing and exporting, but just take that example, right? Let's just say theoretically Tesla did a lot of importing and exporting. The automotive industry, tariffs were implemented, they weren't taken away, they were getting crushed. I'm not saying you have to buy in at good companies that are getting absolutely slaughtered because of the specific market, whatever it may be. There's plenty of examples of companies that go under because of just the worst market conditions possible. And this might be a poor example, but I'm not saying you have to buy into that, but there's plenty of companies in a bear market. The only reason they're down is because people are selling, people are out of the market. That's just how these things go. So I'm not 100% tech. I love tech. I have some value stocks, things like a Kroger, right? Kroger had a decent earnings. I mean, it's crazy how I see a company like Nice, I've covered on this channel. It's much smaller, viewed as riskier, right about $10 billion market cap. It's not that much smaller than Kroger, and they're growing substantially fast. If I'm going off the top of my head, Nice had something like they're projecting 17% growth this year. Oh, we're actually only doing 13. They dumped 15%. Meanwhile, Kroger I think they had like a poor quarter and they guided for 4% growth next year, although they grew around 23% this year in terms of earnings per share. Off the top of my head, guys, not exact numbers, but they went up 5%. Yeah, we're going to grow 4% next year. They're up 5%, almost 5% on the day. And then you get a stock like Nice. Yeah, we're going to grow 12% next year. And their PEs are almost the exact same they dump. So during this type of market, something like Kroger is going to do well. Something like HCA, generally, of course, certain companies do poorly. I'm not saying they can't. Something like HCA is going to do okay. Healthcare industries, just things like that. Something like Vici is actually probably going to do, it depends. If it's inflation induced, partially by it, and you can see inflation if there was lots of tariffs, whatever it may be. Vici would actually probably do probably go down a little bit because of interest rates going up. Why take the risk of investing in Vici at 5.3% when you can get that in something like a CD? So there's going to be all these different things. But if Vici was to go down to, let's say, 28, you park it in that. I mean, it's a pretty safe. Obviously, anything can happen with any company, but it's about as safe as you can get. So I've kind of been ranting and raving on a little bit, but I have money in value stocks like Kroger. Not because I think Kroger is going to outperform TSM in the long term. Absolutely not, I don't. But I still want good companies in value stocks because different companies do better in different market cycles, and that's very important to understand. And if you diversify into that, you can take some winners in that specific time frame, and you can take some of that money, put it in an industry that's getting hit hard, not a company that's just doing bad. Because there's a difference between a company just doing terrible and an industry doing bad, and the industry being very important. For example, TSM, it's really easy. I know this has been a little bit rant. I'm going to wrap it up very soon, but Micron, for example, if you zoom in on Micron, this shows you how cyclical the semiconductor industry is, right? You get that upturn, like that, this consistent upward trend. That's what I'm trying to say, right? 5 to 34 to 10 to 53 to 42 to 80 to 60 to 50 to 109. That's just how the semiconductor industry is. Does that mean that TSM or any freaking semiconductor stock, I talk about TSM too much, does that mean that if the semiconductor industry is doing poorly for a short time frame, does that mean it's not important and not one of the most important things in the entire world and not going to go up in the future? No. But it does mean people don't think it's going to do good right now or the next year or the next 2 years. And people do not like waiting around 2 years to see their money go up. They'd rather park it in a CD and get 5.3%. So you can take advantage of this now. I'm not saying you have to dump every cent. You guys do whatever you want. But this is what I do during a bear market. If I had something crazy risky I thought was going to go under, I generally do not invest in companies like that. Sure, you can sell that. Generally, I like to hold through. I definitely like to hold through on the tech stocks, the companies I truly believe in that are just getting hit hard, because that's just what the market is. But when we're in a bear market, a bear market again, no, a bull market again, duh. Things are doing great. I'm not worried about that. I'm not worried about a company going flat for a little bit, but I do have money in value stocks that I don't mind pouring more, maybe not into a specific company because I have enough exposure, but into other similar safe companies that are just down because we're in a bear market. So anyways, I ranted quite a bit in this video, but I hope you guys got something. This is what I do. If you enjoyed, like and subscribe. I do daily stock content on this channel. I'll catch you next time.